All right, hi everybody. Apologies for running late. I went to the wrong building. And it's not great. No, it's not great. So welcome. We are now, changes in some of the public meeting law means that these meetings are now being live streamed. And they've always been open to the public, but this just is a little bit more. And we have two folks, David and Jim, on the, we're waving at David and we're waving at Jim on the Zoom call. So, all right, so let's start with taking a look at the agenda. It's pretty similar to usual with a couple of extra things on it.
We just have a slide deck kind of taking us through the items.
Great.
So if I...
Oh, look at that. Cool. Okay.
Thanks, sir.
Maybe I should sit at the other spot. I'm going to sit here so I can see that. So are there any changes to the agenda? All right. I would look for a motion to approve that as it stands.
I motion to approve the agenda.
All right. Second?
I'll second.
Okay. Any comments, questions? All right. All in favor of approval of the agenda as stated?
Aye.
All right. You have the minutes of the October 30th meeting. Were there any changes to the minutes that anybody saw? All right. I would look for a motion to approve the minutes of the October 30th, 2024 meeting.
I'll move to approve the minutes for the last meeting.
Okay. Any second? Okay, great. All in favor of approving the minutes for the October 30th meeting?
Aye.
Okay, great. All right, I'm going to turn it over to PFM Financial then for the discussion on the bond sale.
Great. Well, good afternoon. My name is Duncan Brown. I'm with PFM Financial Advisors, LLC, and we are the financial advisor, or sometimes called the municipal advisor to the district. So we advise the district in connection with its debt issues and management, and we are regulated by the Securities and Exchange Commission. We have a fiduciary responsibility to provide advice in the district's best interest. So I'm here tonight, or this afternoon, to talk a little bit about potential preliminary structure for the sale of bonds pending voter approval at the May 20th election. And I'll apologize in advance for the tiny font. It's tiny to me too, but sometimes it's necessary to fit everything on one page. And so I'll walk through this in a little bit of detail, but please feel free to interrupt with questions or any clarifications. And maybe I'll start by just noting that for most school districts, a bond authorization is a multi-series process. So there are multiple sales of bonds within a single authorization. In this case, in the district's case, we have 3 bond sales programmed in here, and that's consistent with prior analyses as well. And there are a few reasons for that. One is because issuing the bonds in series means that the interest on the full amount doesn't start to be recognized until a few years in, so you don't borrow more than you need right away. Another major reason for that is because the district and school districts generally tend to issue tax-exempt bonds, meaning that the interest income for investors is exempt from federal and state income tax. And that allows investors to offer a lower interest rate on the bonds, which means lower interest costs for the district and its taxpayers. But in order to receive that tax exemption, that tax advantage status, there are some limits on how much and how early districts and other government entities can borrow. And basically, the U.S. Treasury doesn't want you borrowing too much too quickly, because this is a subsidy from an implicit subsidy from the federal government. And so those two reasons are really why there are multiple series programmed in here. We've looked at the first series being sold this summer. By assumption in this analysis, it's August of 2025, and then subsequent series 3 years after that in spring of 2028, another 3 years after that, spring of 2031. And that 3 years aligns roughly with the tax law limits that I just mentioned. We've also programmed in here sort of a bell curve in terms of the sizes of each series, which is, these are sort of preliminary numbers subject to further refinement, but it reflects the fact that there are sort of programmatic limits on how quickly you can spend bond funds and actually execute projects under the bond authorization. And that's why we have about 25% of that total authorization as part of the first bond series, about 50% as part of that second bond series in 2028, and the remaining 25% tranche in 2031. And again, apologies for the tiny numbers here. And that translates to roughly $105 million in that first bond series. One of the overarching goals here is to maintain a aggregate bond levy rate of less than 99 cents above the current rate. And so that's one of the limiting factors. You can see, or perhaps you can't, because it is kind of hard to see, that far right column shows projected aggregate bond levy rates, taking into account each of these three bond series. For those who are visual, like me, the chart on the next page shows that in a kind of more color-coded fashion, showing projected levy rates for the existing district's existing general obligation bonds in blue, and then the three series under the proposed new authorization in yellow, orange, and green. And so you can see those kind of layered on top of each other, not exceeding that 99 cents increase, and then kind of staggered step downs starting in 36, 37, and every few years after that. And those step downs are important because they represent future capacity for additional bonds under future authorizations years down the road.
I'm assuming that's not on a PowerPoint slide or anything, right? Did we get a packet that I didn't see? Whoops.
David,
Okay.
that should be in what Jessica sent a couple days ago. Yeah.
Did you? Okay, thank you.
So Duncan, I have a quick question. I want to make sure I understand this graphic. So the blue is what our current rate is at, and then so we're at $1.50, and then we're talking that yellow would be on top of that. Is that right? Which looks a little more like a little more than 99 cents when I look at it.
So yeah, it's kind of hard to see on this chart, but the current fiscal year levy rate is $1.69.
Okay.
And so we're pushing that up to $2.68.
Oh, I see. So it's from the top of the current. Okay. Yep.
That's right.
Okay, thank you. Because that number's going down, so then we have a little more room than just 99 cents. Thank you.
That's right. And I do want to stress that these are projected levy rates. In addition to interest rates on the bonds, they will be affected by future growth in assessed value within the district. So we know that these will be wrong. We're doing the best we can to make sure that they are at least wrong in the right direction. But those are the fundamental parameters around this structure, that levy rate target, three series of bonds, and trying to kind of stagger how quickly the proceeds are realized.
Just a quick question on the assumptions on the interest rates. Is there any concerns that we have to worry about, like 25 basis point move between now and August could be realistic? Does it matter too much at some point?
That's a good question. In a more typical environment for the municipal bond market, 25 basis points is a large move, and one that typically takes a few weeks. In recent weeks, we've seen moves that large in the course of a day. I will say, though, that those rates have they have been very volatile, but they've also been volatile back and forth. And so we're actually not in terms of the tax exempt bond market, and I know Deanne and GPA will talk a little bit about the investment side of things, but in terms of the borrowing costs, the market really isn't that much different than it was even 3 weeks ago. It's been all over the place over the last 3 weeks. There is concern. We do have some larger, I guess, assumed rate increases baked into the 2028 and 2031 bond series here of 1% and 1.5%. Is that sufficient? It's very hard to say. And again, in a more typical environment, I would say that's, it would be conservative. It's hard for me to say that currently, based on what the Fed has telegraphed in the past and what bond 30-year long-term bond market futures suggest. We don't see a lot of upward pressure on the long end of the curve, but it's very difficult to forecast. I think that does argue for trying to kind of get in when you can, and so that's why we are having conversations about how to hit the ground running for that first series of bonds if voters approve it later or next month rather. I don't know if that fully answers the question, but it's something we're monitoring.
Fantastic. That's good. Thank you.
Generally, are the bonds getting more or less expensive with this volatility in the stock market going down?
Well, depends on the day. Not to be glib, but it really does. I mean, there have been some very challenging days in the bond market, and today was a great day. We had we worked on some bond sales this morning, and they went out and got very good reception because the bond market had rallied, meaning rates fell, and so prices went up. And in this case, we want lower rates, higher prices for bonds, maybe a little less so on that side of the balance sheet. But there is still market access. There are still bonds being sold. There will be a number of other school districts that have already announced their intention to sell bonds under existing authorization next month. And so that'll be an interesting bellwether to see a lot of the peers in the metro area sell their bonds. But it's very difficult to say what will come of from a macroeconomic perspective and also from a tax code perspective, because I mentioned the tax exemption on municipal bonds. That is probably a little less under threat than it was even a few weeks or months ago, but that is one of the elements that's being considered by Congress in connection with the proposed extension of tax cuts, is either a reduction or elimination of that tax exemption.
Okay.
So that's kind of a downer, but I think those are the things we keep an eye on and try to keep tabs on and try to plan around. But at this point, I don't have a lot of specific guidance on where interest rates or the tax code may go in the next months or years.
All right. Well, thank you. And thank you for preparing for us in the event that because we're going to pass this.
That's the hope.
So.
And just wanted to add, part of looking at a proposed method was because depending on the outcome of the election, we would potentially be looking at a first issuance prior to the next finance oversight committee.
Yes.
So just wanting to provide some preliminary assumptions, knowing that there's a lot of things at play, staging for work, availability of, providers who are doing construction, tariffs, impacts on prices. So a lot of variables we'll continue to consider.
Yep. All right, thank you.
Thank you.
All right, shall we move on to GPA?
And we'll just transition over to your slideshow now.
So it's good to be in front of you tonight. There's a lot of new faces, so it's nice to meet you. Mike Clark and myself are both partners and owners of Government Portfolio Advisors. We are right down the street from you. We're right on Carmen Drive. I'm really proud. You guys have been a client of ours. We started GPA in 2014. Prior to that, we were with another firm. We started with you at that other firm in 2010 on your first bond issue. So we've been on this rodeo with you guys a couple times for a long time. So we're here for you, and we're going to cover kind of some of those components. GPA currently is one of the largest independent investment advisors in the country serving local governments. We work in 9 states. We manage $25 billion in assets at this time, all treasuries, agencies, high quality corporates. And you guys have been a partner with us and really helped us to get that leadership with our clients and the success. So we really are proud to be partners with the school district.
Deanne, I'm sorry. If you want to progress slides, if you don't mind just saying next slide.
Next slide. I will say next slide, please. Thank you. So I wanted to give you that little bit of a background. Back then, Marcia, I think you were on the committee when we started this.
I had just joined.
Just
so yes.
joined us. So we work in several components of your portfolio. We manage your core reserve funds, which right now is sitting around $14 million. That's the budgeted reserve that you're required to maintain. And we manage that, and we'll talk a little about the structure of that. We watch those reserve requirements. They've come down a little bit for you, but in our last meeting, we normally meet with you in November, review policy and strategy. But this is a great time to do this before this bond issue. We've also handled all of your bond issues since 2010. You still have a little bit remaining in your 2019. There's about 12 million, so we're used to this kind of laddering and waterfall kind of process with that. And then we also work with you on your policy and meeting the objectives of the requirements of state statute and the Oregon Short-Term Fund Board. I serve on the Oregon Short-Term Fund Board, so I'm always aware of what's going on with school districts. So it's great to be in front of you, and if there's ever any questions, don't ask us about the stock market. We can talk bonds, but the stock market's kind of tough to challenge. I was on vacation when we got the big on April 2nd, and so I was trying not to be on my computer and my phone, but I peeked and I went, oh, I'm just going to turn it off. I don't want to watch it. I did bring in some slides. Next slide, please. I did bring in some slides just because there's a lot of news out there right there for you all, and I wanted to make sure that when people ask you, are our investments okay? What's happening? Tariffs. That graph didn't show up quite right on that table. I'm not sure why, but tariffs are a big topic, and basically tariffs are tied to inflation and higher costs. You're going to be seeing that in your pricing of your project funds. We don't know the outcome. The big words we're seeing right now is chaotic and chaos and uncertain. Uncertainty is our big word. So this top graph, which doesn't look the same on your table as on mine, is it correct in your books? Okay. It's really showing, too, the point that Duncan had. We don't know where these rates are going. We know they're going to be up. We know they're going to be down. We know they're going to be all around. And I can say that it's just march forward, have your plan like you're doing, do what you need to do for the district, and then it'll all sort through. It just, you can't time. We don't know if rates will be higher on your issue side. Of course, we like higher rates for you because you earn more. But it really is just to kind of show that we are moving up and down. We're going around. We can't predict, and that's not our jobs. It's our jobs is to work within what we have, and for you, a lot of it's what your cash flow needs are. So I have some impact. So right now the economy is driven by consumption. So we're going to hear a lot about consumption. Our consumers there. Is employment strong? Employment has been holding up through all of this. You know, you go to a lot of places right now, and people are looking for people to work. So as long as we have employment strong, and as long as we have consumers out there, that will hold up our economic GDP numbers. And then it will just be that inflation number, which I think we'll start to hear. Instead of that being a target of 2%, they'll probably bring that up a little bit. That will then give the Fed the opportunity to reduce rates on the front end. Everything that you're investing in is basically 3 years and shorter. So when you hear about the 10 years all over and where's this going, and you're not even involved in that. You will be on the issue side, but on the investments, we're not exposed in those longer term investments. Next slide. Now, on the right-hand side, whoops, That was my Fed. This is the Fed funds talk. So again, just consensus, uncertainty. That's just showing that we don't know where it's going. And then on the next slide is the yield curve. So that's the other big topic we hear about, yield curve. We've come out of a historically longest time we've been inverted. What inverted means is that short bank rates, pool rates, overnight money is higher yielding than our investment rates in the 2-year and the 10-year. What that typically tells us, and from an investment perspective, is that rates need to come down. That you're not being compensated more to be investing long, you're being compensated less because you think that those rates are good rates for the long term. So, and that's exactly what's happened on this table. In 2024, we hit our peak where short rates were about 5.5. And then the 2-year note was all the way down around 4.5 in interest earnings. And now we're down to about 4.20, and the 2-year is down to about 4%. That should be normal. You should have a lower rate in the front end and a higher rate in the long run. That's why you invest a longer component of your money. So that's kind of the dynamics. The 10-year is what, 10 to 30 years, what your issue level is working off of, and the short end is where your investments are from. So when you hear that terminology, if you hear the 10 years coming down, that's good for the issue side. Okay. And then that bottom rate again is just showing that, again, the rates are bounce all around, and we just work within it and advise you to, based on your cash flows and what your needs are. Next slide. And go one more slide. So this is kind of interesting per the discussion. So the market will project out. We can look at what's called forward rates. What is the market pricing into future pricing of securities of the 10-year note and of the 2-year note? So for the issue side, we're talking 10 years. For the investment side, we're talking the 2 years. So what the market is telling us right now is that over long runs, now we will be bouncing, but the 10-year really isn't projected to come down very low out to 2027. So in these issues that you're doing, if this is right, issue. No, there's no, I mean, you have to issue anyway if you can vote on it, but it'll be okay, right? On the investment side, it's saying rates are coming down from 4 down to that 360, and we're just constantly investing based off of your cash needs. But the trend line that we're seeing is for interest rates to be lower. So that's kind of what we're expecting, and we've had an opportunity in this last round to invest higher for you, which has worked out well for the district. So that's kind of the background. Are there any questions on the markets as a whole before we dive into the portfolio structure?
I just think this graph of March is fascinating. The one that just bounces all over.
Oh, it bounces on, yeah, it bounces all over.
And that's just 1 month.
And that yeah, it is. And I've been in the markets a very, very long time. And as Duncan said, normal used to be for you to move from 4% to 375 was a big move. And today we're moving that in a day when we open up the news. So it's all just about managing expectations and having a plan. So that's really the key. The next slide. So for you, what we do here at GPA is you guys have your investment policy, and then we make investments on your behalf based on the policy and based on the strategies of your portfolios. So we provide a compliance report that's tied to your investment policy. Investment policies are really important because that's your guidance as the board and as the committee to say this is the parameters that the portfolio or any investment should be maintained. We do the policy across all your accounts, including your bond proceeds, just to make sure everything's aligned. Right now at the end of March, you had about 40%, 39% in U.S. Treasury securities. You had about 48 million, which was about half of it, in the LGIP pool. And then we had a few agency securities. So we're mainly investing in treasuries, agencies, and then you're using the state LGIP for your cash balances and some bank balances. And you have about 14% in bank balances. The other area that we have constraints on the policy is within maturity restrictions. So you're allowed to go out to 5 years. We only invest that reserve account out to 3 years right now. Is that right? 3 years. And we've looked at that. We didn't go longer with that because of the cash concerns that you had last year here. So that's something that we will keep an eye on for next year. If balances are short up, we may recommend to use a little bit longer, but right now we're sitting fine with the 3-year maturity. And then just a little bit about the components, and there's enough of you that are new. So our terminology that we use is liquidity. So we always want to make sure that you always have liquidity. You need to pay the bills, you need to pay the bank. And your trend line comes, you get your tax revenues in November, and then you have high balances, and then you spend, and then when you get into the summertime, you don't have money coming in anymore, and it spends down, and that's your low balance hits right about June or July. And so we know that pattern, and so we have a planning schedule that we look at on investments for that. The cash match, we brought that in because when there's a limit on the LGIP of 61 million. You guys get about 130 million or 140 million in the revenues, so we have to place that money somewhere. We don't want to invest it long. We don't want to leave it in the bank. So we use a portfolio called cash match to park funds. We did you had 60 million, 62 million. You had room in the pool, so we left some of it there, and we invested about 42 million. So the key is that we're just really working on always optimizing your balances. We used to just go out and park it in June and let it mature, and then it would go to the pool. But now we're even more concise, looking at your payrolls, looking at your timing, because again, there's a little bit more uncertainty on your budgets. So we're making sure that there's flexibility in that portfolio. And then the core investment portfolio is managed to a 0 to 3, so it's laddered. We constantly have maturities, but we really try to keep that, and we haven't used that forever since we started it. The 14 million stays there as a true reserve, and we have an ongoing investment strategy that when a maturity comes up, we meet that strategy. And then lastly, we have your bond proceeds. So 2019, we have a remaining balance of about 12 million from the 2019 bonds. Did you have a question, Jessica? Okay, question? Oh, okay. Oh, slide forward. Yes. Can you move? I'm moving forward on you, and my back's to you. So one more slide. That was what I was just on. And then we'll go to the next page. So this page illustrates the structure that you currently have. So I mentioned the 14 million in the core account. That's invested right now at a 4.29%, which is a great rate. Anything above 4%, that's what we're trying to. When we've been through this cycle, we were investing at 0.5 back in 20 and 21. So these are dollars that are really contributing a lot in earnings in the portfolio, reflection of the rates. The cash match is invested at about a 432. That's the one that we parked and laddered for your short needs. And then when we come closer and have excess balances, we'll look at, are you better off in the state pool or investing? And then the general liquidity is in the state pool. And the bank, and that's a combination to the 364. And bond proceeds, I do have a typo on there. You're earning about 460. We had a cash withdrawal that hit at month end, so it looks like it's a little bit lower, but you're at 460 on the bond proceeds. So we target benchmarks to each of those and are very diligent in how those are managed. The next page, page 12, looks at that history of the balances. So again, this does include bond proceeds, but it's kind of the high and the low and the trend line. So we see you get higher coming into December and January, and then you use those funds coming into June, July, August. So that's where we park to have those uses. And then again, you have bond proceeds in here too, and then you fill back up. So that pattern is just kind of our normal pattern. And you're fully invested where we should be, and the rates are attractive. And then the next page covers that strategy and how we look at it. A little note, that's not December 31, that's balances as of June 31, and this is just to reflect how we shift. So June 31, you did not have, June 30, 2024, you didn't have a cash match because that was all the money that you needed, went to the state pool. Then you spent that through the summer. And then in December, we increased that and created the cash match. So those are the components. And it's working really well. It's good for Jessica and Sarah and I, and Mike, we all communicate really easily. We know how these are set up, can make concise. They know when there's something changing to let us know. And so that's the pattern of the portfolio. And then I did want to note on the income. So we did track the income so far. So last year, the income earnings on the operating portfolio was 2.7 million. And in 2024, 3.6. And so far this year, we're at 2.6. So we're on track to be close to what you had last year. but we do expect them to start to come down because those interest rates have come down. So in investing, it's just all about managing expectations, what should be happening, and if rates are coming down, we're going to expect that we're not investing at those higher rates. But nice earnings compared to 2023, the earnings were about $1 million more in income. So that's good. And that's really it for the overall portfolio. Is there any questions? And we'll talk
Yeah,
about
just
bond
to-
proceeds. Mhm.
Yeah. Oh, I was going to ask about the bond proceeds. So the bond proceeds come in, they get split between the liquidity and the investment
So
strategies. But who makes that determination of split? Is that the district? You guys? Is it?
in how to invest it?
No, well, the split, right? That's what it gets
The
split
split.
between liquidity and investment, right? So
Oh,
that's
we
a-
work on that together. So, so with the bond proceeds specifically, when we design the structure, so that will be on the next page. One more page, sorry. So this is the 2019 bond. So we take all the disbursement schedules. So Sarah will send us a list of all the different projects and all the cash needs and dates out of those projects. We clean it, and then Mike magically makes this spreadsheet happen somehow. And we look at what the investment line is. And then we determine for liquidity how much you want to have daily for uncertainty. And so we'll probably have that a little higher because there's a little bit more uncertainty going on right now. So that liquidity is invested in usually in the pool if there's room in the pool, or we'll keep that in the bank accounts. But it's really determined when we look at the structure and we look at rates. And no, you probably have some reimbursable expenses that will come out of this, so that will go right to cash. And what we do at GPA is maintain all those records for you from day one, whatever the funding amount, the $101 million on the first round. We'll make sure that we have that document where that went, so that for all your documents that you have to report, we have all the data in there. So it's all driven off the cash needs. And then the numbers in red there show you that you didn't spend on the schedule, which is normal. So all those were set to be spent in 19, and then there were delays in your projects. So then we had to go in and ask, okay, what do you think you're going to spend on that in the future? So you ended up earning more on that bond proceed than our initial projection because it wasn't spent as quickly. And I can't remember if there was a whole school that or something. I can't remember what the deal was.
Yes, Art Ruck, and we had a lot of land use issues, so it got delayed by almost 2 years.
Mm-hmm.
And so luckily interest rates were higher, so we were able to invest that. But it's based on when we hire the general contractor, they give us a schedule of when projects are. And then with that, we know how much soft cost of the projects is, and I kind of benchmark of when we will have pay apps. They're always at least a month behind, and that's how I come up with our cash flow needs. And then we don't ever want to sell something, and so we'll formulate a formula to say how much cash do we need on hand, and we leave that in LGIP. So that's like a checking account that we have access to.
And that you can sell something, but we usually don't want to sell something because if interest rates are higher at the time that you need to raise that cash, we might incur a realized loss. So we try to really manage that. And that's the same thing in your own portfolio. We really look at the liquidity needs first so that we're not forced to sell something in an untimely manner.
And that's sell versus mature. And we haven't had to do that ever
Right.
since I've been here.
So as soon as you have the cash flows, as soon as Sarah has the cash flows, then, and you're getting closer to your timing of the issuance, the key is as soon as that gets issued, then there's a closing date, usually how many days? Like 2 weeks. So the bond deal sells. So let's say it sells at a 375 yield. And then we have to wait until we have a 2-week period that we have to wait until you have the money for us to invest. So once you have the money, then we have the schedule already. We'll already have all the prep to Jessica and Sarah on what the structure is going to look like. And we let the money hit the account before we make the investments to make sure everything's funded.
And we have to make this decision within 10 days because we only have 10-day limit to be over the LGIP limit.
Right.
Or else we'll get penalized.
Yes. So we will all be ready to go as soon as that thing gets passed.
Great.
And that's it for us.
That's it?
Yep.
Awesome. Thank you so much. Okay, we will go on to the financial oversight questionnaire, which again was in the materials, should be in the materials, I think.
Yes, thank you. And there's some paper copies as well. So we'll move up to agenda item 7. Next slide. Yep, thank you. So we approach sharing about controls and district practices in 2 different ways over our 2 different meetings. And this is just an update on specific components. So let me just pull that open. So I'll do a high overview for those of who have the handout. So specifically in terms of budget practices, we like to engage our community and once again held 4 community budget work groups over the months of February and March. We went on a little bit of a tour this year, splitting those meetings between here at the training center as well as Byram Elementary and Fowler Middle School. We also make our budget publicly available. It's also submitted to the Department of Education and our ESD. And then we are continuing to use the Smarter School Spending initiative and academic return on investment to make budget decisions. And typically we do that for resource allocation, but in a year like this year where we're looking at a deficit, that process is even more important because it helps you clarify what you hold sacred and continue to invest in. So, and then of course, complying with local budget law that's specifically reviewed by our auditors and attested to in the Oregon compliance report. That's part of our audit. Next, going down to financial reporting, we continue to provide regular updates to the board, specifically related to our general fund. And those reports and analysis are available in each monthly board packet. As we talk about the audit, our audit for June 30th, 2024 was completed on time, which we have a little bit of a municipal auditor shortage in Oregon. And so ensuring that you can have that audit done and submitted, it helps ensure we receive our state school funding. And so we're just appreciative of our relationship with our auditor. And Sarah leads the team in exemplary work for that component. So we continue to present our financial statements according to generally accepted accounting principles, and our auditor attests to that in their report. And again, making our audit available for any community member who would like more information. They can find that on the website. And for the fiscal year ending June 30th, 2023, that marked the district's 36th year of receiving the Governmental Financial Officer Association's Certificate of Achievement for Excellence in Financial Reporting. Our results for 2024 are still open, but we typically hear about the prior year over the summer. So not knowing now isn't anything atypical. When it comes to financial oversight, thank you for being here. We rely on our Financial Oversight Committee to talk about a lot of the components we're talking about today: investments, insurance, risk, and we appreciate your contributions. And then finally, especially in a year like this year with a long legislative session, the district continues to participate in advocacy, specifically whether it's through the National Association for Superintendents and Administrators, where we're looking at a lot of federal grants and funding, as well as Ethan working with COSA and Sarah and I working with OASBO. We work on statewide initiatives and then are also in specific focus groups for districts over 10,000 students. Other items are our investment policy, which Deanne shared a little bit about, and we're going to do a full review over the spring. Yep, and bring it to the committee in the fall. And then we also have our staff ethics policy, and I'm pleased to report all required filers met that April 15th deadline. I remember I was checking the website a couple of times last week. Yep, tax day, of course. So, but we continue to, those responsible will do their annual filings, and we specifically do ethics trainings with administrators at the beginning of the year. Are there any questions about the semi-annual update?
Nope.
All right, we'll move on to our annual review of insurance. There are a couple of changes that I wanted to go over, and I specifically provided for those here oh, and actually I have the next slide, so we'll hold on moving to it, but It wasn't in the packet, but looking at our insurance coverage, we continue to, I guess we'll start with the top of the document. What we don't cover, we don't have explicit medical insurance for students. That's sometimes something that is brought up, whether like, of course, certain components of coverage for student is covered under our liability policy, but we get a lot of questions about health insurance for students, and we have a voluntary policy that students can apply for directly. Those applications have significantly decreased with the expansion of Medicaid, but that has been a longstanding district practice. The other item that we typically don't cover are volunteers. And I made a note here, except for certain committee members, because that's one of the changes that we'll be bringing a resolution to the board based off of a recommendation of our broker, as well as a review of our board policy. When it comes to workers' compensation, we do cover some of our students in their career ed tech programs. That's because they meet about 4 criteria that the state says that students need to meet if they're going to be covered by workers' comp. We're looking at about a 0.05 increase in our mod factor. So that combined with changes in covered payroll will probably result in an increase. The percentage isn't specifically known at this time since we're still going through renewal, but I know last year we said approximately 10%, and I don't think it would be that much for this year, but just wanted to throw that out there. Last year, and for the current year, our total workers' comp insurance totaled $370,000. And there are certain years where we get dividends back because we participate in SAFE. And as you can see, if you're looking at the 4th bullet point, those run about 2 years in arrears. So our most recent dividend was related to the 22-23 policy number. So as I mentioned, related to workers' comp, we'll be bringing a resolution to the board to cover board members as required by board policy, as well as certain standing committee members. One of those, which would be the Finance Oversight Committee, the Long Range Planning Committee, and the Bond Oversight Committee. So that's just will align our practice with our policy, but it does require a board resolution to actually go and cover those employee or volunteers, excuse me. Property, our premium this year was $611,000 approximately, and unfortunately we're looking at again a rate increase of anywhere between 17 to 20%, which just hurts, specifically in a year where we're trying to balance a budget. Again, Oregon with wildfire risk, we kind of have a micro market concern, and then you just look at losses worldwide and reinsurers and the pressure on those. And so that's typically being just handed over to policyholders in terms of rate increases. Our limit remains at $100 million per occurrence, and we have a $25,000 deductible. So sometimes some of our intermittent losses during the year are self-funded. We just pay, elect to cover them so we don't impact our loss record for property. The earth movement and flood is limited.
Yeah, I had a question about the insurance. Does the company offer anything around mitigation, like fire safe materials or defensible space that would make the premiums go down, or are they just generally spreading that liability out to everyone evenly, no matter what?
Yeah, good question. So specifically, our district receives our coverage through PACE, which is a statewide trust, which covers nearly all public schools and community colleges. And so, of course, we're tied to struggling for words here. Our declaration document and our policy establishes certain criteria that all members will uphold to be covered. I can't speak to specifically whether in property that's articulated. I will say, though, PACE, based off of loss and assessed risk, provides incentive programs, which I'll get to. The types of items you mentioned, though, haven't like been brought up. Like PACE hasn't really been looking at fire defense selections or that type of thing. So again, just looking at earth movement and flood, there are, $15 million and $10 million worth of coverage. If there were to be a regional issue, though, most likely that those additional pool-wide maximums would be very quickly exhausted. Typically, there are very few districts who choose to buy additional earthquake or flood coverage just because of the cost. As you can see, about an additional $10 million is about $80,000. And so that always is an option. And then just a caveat, the PACE will send out an auditor to review property values. We received our interim results from our recent review, and there were quite a few errors. So we're working through the reconciliation and assumption process to make sure, especially when you're looking at just this. Good evening, Templeton family. We hope you're enjoying. Sorry, we'll just hold for a sec. In about 10 minutes, we're going to have our next demonstration, which is live animals. That's live animals demonstration. Speaking of insurance. Oh, pizza and
We don't have any.
We're in the wrong meeting.
Good morning or evening, Templeton family. We will be discussing financial oversight.
Yes. Yeah.
There will be no pizza.
No. So anyways, we're just working with them just because of the premium rate increase. Of course, having overinflated values would just drive that up. So special thank you to Jarvis Gomez, who's working line by line through that report as we're going through our renewal process.
I'm just gonna say, let's hope we don't have earth movement or flood, because those seems like pretty low numbers, and I get that we can't afford to buy more, but
Yes.
Yeah.
Yep. Like I said, I think I know of only one district statewide who buys additional
I'm not surprised.
coverage. Yeah. Boiler and mechanical is pretty consistent and comparable with the prior year. Liability, I do want to point out, there is something that's changing. So could we please go to the next slide? So you have a handout if you're here in person. This is the program structure of all of our insurance, and it talks about the type as well as the applicable deductibles or premiums. One of the items that is changing is that just because of statewide and national claims related to sexual abuse and molestation, PACE was not able to procure a reinsurer for the $10 million. The top tier of $10 million of coverage. So specifically an example might be the second column from the left is showing all liability insurance, but if you were to look specifically at sexual abuse and molestation for the 25-26 year, there will not be an excess liability or like a reinsured amount. So the district is looking at a separate policy to purchase to bridge that loss in coverage. So I do want to just share that, and that is included in our budget assumptions for 25-26. We can go back one slide. Thank you. So other than that, automobile and crime and cyber liability are all consistent with the prior year. Again, we do have additional cyber liability coverage. And then we continue to participate in the Employment Practices Toolkit. That's that incentive program that if we complete or demonstrate best practices in a specific tranche of risk, we receive a 5% credit to our liability premium. And then again, just at the bottom, sharing total premium, 23-24 was $971,000, and 24-25 it went up to $1,086,000, and we're again forecasting we've budgeted the full 20% increase. So hopefully we'll have a good surprise there, but we're trying to be conservative. And then finally, we continue to use Brown & Brown as our broker, and our fee for this year was $43,451. So that is it for insurance coverage. Any questions? All right.
The abuse amount, obviously there's been issues in Oregon in this area. Is there anything the district can do to mitigate that and reduce the likelihood of that kind of thing happening? Obviously, we all want that, but assuming there's already kind of everything being done, or is there any recommendations additional that we could do as a district? And then obviously an issue is statewide.
Mm-hmm. Yeah, I would say PACE specifically, I want to say 3 or 4 years ago, that area was part of the incentive package just to refine like best practices and district expectations. So I think we're always looking at how effective I would say our thorough training process is. Like we have, we're not only complying with them, and maybe Ethan would be a better person to answer this. Like we're not only complying with like the minimum requirements, but I think there's always an opportunity to assess effectiveness and just make sure we're not waiting in the yellow zone, or like we're always in the yellow zone, not taking things when we're looking at risk management and just being aware of items. So that's what I have. All right, the next items are just FYI, so we could go to the next slide. Sorry, one more. So I believe in the fall, we gave an update on our Moody's rating, which did change. We were downgraded and provided an advisory. I'm blanking on the term.
The notice to Emma.
Well, no, we did the Emma notice. We were downgraded and then had the asterisk for subject to further review.
Oh yeah, the negative outlook.
The negative outlook. 2-word bummer. Yes. So we expect they will want to revisit our results with our 25-26 budget being finalized. But meanwhile, S&P 500 also reached out and requested some additional information which the district provided. So we will have an update we won't wait till October to provide the board with an update, but we specifically knew what negotiation outcomes were going to be, what our projected ending fund balance for 24-25 and 25-26 are. So, but they're still sitting with that information, and they haven't reached out for any clarifying questions as of yet. Next item would be scheduling our next meeting and the format.
I'm going to grab my calendar.
Sure. And I believe our fieldwork is the 20th through the 24th. So we typically ask if we can meet after that.
So sometime after October 24th.
Yes.
Yeah.
Okay. As well as if you guys would like to meet virtually or in person.
Right. And I'm just going to observe that I think we lost Jim and we don't have Shannon here either. So I think we do a proposed date and then find out if that works for folks. And if it doesn't, then we'll have to work via email to come up with a date. Do you want to do it soon after the 24th?
We're going to talk about the
Do you need any time? For the next.
Our policy, and we'll be looking at the strategy, so probably should do relatively soon because we'll be getting the money out for that. We would have it before this. We would already invest. Yeah. It would just be informative.
Mm-hmm. So it doesn't matter for you?
So the next Wednesday after audit fieldwork is the 29th.
The 29th?
The 29th is good.
29th of October looks good for you?
Yeah.
And then, does that work for you?
Would there be any chance we could do a lunch meeting? Or does it always be in the evening?
I can't do a lunch meeting.
Sorry, David, we have to wait for the announcements.
Oh.
That's the pause. Because we could go see live animals and eat pizza, but we're not. So, okay, so I heard David say that lunch does not work. Does 4:30 still work for folks?
Yes.
So maybe we pencil in 4:30? Yeah, is there a better time? Yeah, lunch. 8 a.m.
Crystal mentioned 8 a.m.
Yeah, David, are you open at all in the day, or does it have to be afternoon?
For me, it would have to be afternoon. I mean, I could potentially do a virtual meeting during the day. So if everybody else needs or in the morning, then yeah, I can go ahead and do that.
Okay.
So we can say October 29th, and then we'll either do a
And then work on the
doodle
timing.
or something to kind of have
That sounds
everyone
great.
share their best availability. Okay.
Okay, so the plan is for the next meeting to be October 29th, and then we will do an email poll to figure out what timing we can do.
And would we like to go virtual for that?
It sounds like virtual may be easier for folks, so maybe we do one meeting a year in person and one meeting virtual.
Okay.
Something like that.
Okay.
It is nice to have the in-person contact, but
It is nice.
also the convenience, so.
Of course. All right. So we'll reach out to the other committee members.
Great, thank you.
Next item is just a couple updates regarding the audit. So typically our auditors are here. However, our contract with our former firm ended with the culmination of the 23-24 field work. So we went through an RFI process in early March. We took our recommendation to the board on Monday. And so we're currently under contract negotiation with Clear Trail CPAs, who was the successful provider of information. So we will have them on contract, and they'll be able to attend, future finance oversight committees, but specifically with the lens that they were providing, it's technically a new firm, although it is the same shareholder and manager that has reviewed our financials for the last 5 years. So, and again, I just want to tout, we sent out RFIs to 6 firms. We received 3. Very lucky, again, just with the municipal auditor pool. I've ran into several districts who haven't received any proposals before, and just from a contract and negotiation standpoint, that can be very hard. So lucky to have 3 people who are interested in working with us. And just items that we'll be including in our audit field or the preparation of our financials. I know these were reviewed, I believe, last fall, but GASB 101 specifically talks about reporting compensated absences, of which the district will be subject to. And then GASB 102 requires more significant or additional risk disclosures for non-isolated events or those types of things. So we'll be implementing those with our financial statements. I believe that's
Okay, all right. And then the last thing that we do in this meeting is we ask the superintendent to leave, which obviously we don't need to do since unfortunately he had a commitment. And then we look to you folks and ask if there's anything that that the superintendent has asked of you that made you uncomfortable, anything that you would like to raise with the committee as a concern, or even as just a feedback item.
No, nothing of concern. Really more of a partnership relationship like we had with Dr. Sue. Really values our opinions as experts in the area, and then we work together as a team.
Yeah, no areas of concern, and specifically I just appreciate his leadership. We had to do a mid-year budget revision, and so that was, being a new superintendent to a district, that can be something that's hard to lead a district through who hasn't had to do that in recent years. And just again, approaching our 25-26 budget, been a very helpful facilitator and helping us look at our program delivery and trying to lead through that process with care and transparency. So
Great.
That's been helpful.
Great, thank you. Before we adjourn, I do want to apologize for being late. I will next time look more closely as to where we're meeting. So apologies for wasting folks' time on that, but thank you all for waiting for me, and So we will adjourn this meeting.